Eric Muade. This video is meant to be a follow-through for the previous video here. So this is meant to be part 2, and even though we are looking at intraday trading, I'm gonna use longer term chart setups to show you how what happens on a longer time frame can also take place on minute time frame. So this is meant to be part 2 of this video, and so take a look at part 1 before you go to this part. And there's one more other laundry business here I have to take care of, and it is just reminding you that if you really want to take the most out of this current video, take a look at my work on my playlist. I have a playlist called Wedge Breakout, RSI Wedge Breakout. So take a look at that. It's a long series, so if you can have time to consider this series, and it's lots of videos here, so take your time, there's no hurry. I show here about 19 videos talking about the wedge breakout. If you can understand the wedge breakout, and also if you consider part 1 of this video series, then this current video is going to make a lot of sense. So what we're going to be discussing here is looking at the RSI, of course, and we are using it for day trading, intraday trading, medium term trading, swing trading, and sometimes longer term trading. So what we are looking for is any type of uniformity or symmetry. As you know, that's the key here, uniformity and or symmetry. And if we can get it from an extension of a line, let's say this is a line, and if our stock had been bouncing and finding resistance, if at some point we break out, then this becomes an established line. So if the stock has a nice run, what we can do is we can use this, any move in the future back to this extension of this line, any move back to this line with uniform activity of any kind, like that, any kind of uniform activity, an extension of that line down the road. And it doesn't matter what kind of uniform activity you get. You could get something even close to the line but not at the line. There are so many ways you can get uniformity. Even something like this is uniformity. So this become where you buy. So you buy when the RSI shows you uniform action at a previous line that was a critical buy signal. So we are assuming here that this was a buy signal on the way up and the stock had a nice run. So every time the price comes off highs and it comes and finds support, we buy. It finds support here, we buy. So that's the key. We can summarize this as being as simple as, once you get a nice established line on the RSI and there is a movement in the stock that is a significant movement, then you just extend your line. In the future, should you get any type of uniform action, you want to use that as an entry level. And we're going to see lots of examples covering multiple markets and multiple time frames and also multiple sectors. So this works on any trading instrument anywhere across the globe. That would be my thinking. Also, you can use this whenever there's a break. Let's say the stock had been running up, having nice support, and then finally at some point it breaks down. So what you're going to do is, in the future, should the stock come back to this line and show uniform activity, you want to use this as a sell point. And the only way this makes sense, in my opinion, the only way this can make sense and should make sense is if you have uniform activity. If you don't observe uniform activity and if you don't observe symmetry, then don't take the trade. The trade only works when there is confirmed uniform activity weaving itself above and below, or below and above an established line. So you want to look for uniform activity of any kind. It could be one of these, it could be V-type formation, it doesn't matter. But whether you're going long or short, the key is symmetry. Symmetry has something that tends to be very actionable in the market. So let's take a look at some ideas. And just one more thing is, whenever you're drawing your line, so let's say this is our RSI and that is 69.1, that is 50, and that is 30.90. So 69.1. Most charts will have it at 70, which is okay. And then of course 50 and 30.90, and most charts will have this at 30. Just either way works. Whenever you're drawing your lines that we're going to be looking at, you want the line at least to touch 69.1, the high on the RSI previous to have traded somewhere here around 69.1 or above. So one of the requirements is you want your line connecting RSI high that is above and close to 69.1. And if you're drawing a line from the lows, you want your line to have at least come to this level here, 30.90. We'll take a look at some examples which should crystallize what I am saying. So we begin by taking a look at the Nasdaq daily, and this is between 2011 and 2012. So Nasdaq daily 2011-2012, and we can see there was a nice move in the market, this breakout here, and a nice surge. And so we find out where the RSI broke out. It's very simply, this is where the RSI broke out. So what you do, and the lesson in this video is, don't delete your lines. Keep your lines on your chart, or at least when you're finding points to go long, draw the lines and extend them. So we know that this was a nice entry point here, beginning of 2012. Extend that line, and you can see that at some point here the market did come back and kiss that line, which is this lows. So if you're a day trader looking for short-term trades, that's where you go long. Okay, so let's just extend the same line for the sake of understanding what's going on here. In fact, I can draw it like that, and you can see that at some point there was uniform activity above the line and back below it, and so you can also use it to find short-term sub situations. It went above the line and back below it with uniform activity, which happens to be this high, and if you're looking for short-term direction, that led to this move lower. Down the road, you can see that the market was also bouncing. So this period here, these lows in the market, this low and this low, correspond with the market coming back to the line there, there, and also there. So those three lows are this market coming back to that line and close to it and bouncing above that line. So how that makes sense, I don't know, but if you can see here, all of this were very positive in terms of day trade opportunities. Also, let me extend this line even further, like that. And you can see again, we come here, we touch a line. There's a lot of examples in this video, so I'm going to do it quick. Uniform activity there, which is, let me take a look, which is this short-term 2-day rally or 3-day rally there. Uniform activity below the line and back above it, which is this short-term congestion here. Not the most successful, but it was positive. And again, you see here we come below the line and back above it. It's not the most uniform. In other words, the market looks like this. The market did something like this. Broke below it, went up. You can argue it's uniform activity or not, but the bottom line is once the market moved above that line, you had this move for a couple of days short straight to the upside. So all this began by extending the previous breakout line. So keep your breakout lines in your charts because they might give you more information down the road. If you observe any type of uniform activity, the trade could be working in the direction of the uniform activity. So let me clear that off, and you can see here on this chart, if I take the previous break level, so there was a break in the market direction here. So the market had been running up. It came here and broke down and had a couple of weeks down during the summer of 2012 or early before the summer of 2012. So what we do, we know that the break point took place there. So we keep our lines on the chart and we extend that line. Well, let me draw that differently. So there's a slight node somewhere there. Hope you can see slight node over there. So I'm going to use that to draw my line. And remember, you can adjust your lines as you wish, as long as it makes sense to you. You can adjust your lines, especially if you observe that if you adjust your lines, that there's uniform activity above and below your lines. What I mean by that is, let's say the market had been, let's just give an example of how you can adjust your lines. Let's say you want to draw a line somewhere on your charts because the market has been making highs like that. Now, if you observe that this line would make, there's an area in the market that looks like that, and then another confirmation, let's say with a double top like that. In other words, if your line makes sense, if you draw it here because it connects more highs, then keep this line if and only if the line that is not connecting the high, for example, in this particular example, you can see that you can draw your line through this hump and V-type formation because it is uniform activity. So if you can adjust your line, there's no hard science. You can adjust your lines as you wish, as long as if there's a line that is not connecting the highs, if the line is uniform activity observation visually, then you can draw your line through that line. Because I think my understanding of why that is the case is because in the example I gave you, when the market went up and down, which is uniform activity, what the market was trying to do was actually do this. Be flat. The market was trying to be flat at the RSI and go down. So all this is averaging out as being flat. So if you see uniform activity, and we'll see some examples during this long video, just know that you can draw your lines as long as, and you can adjust your lines whichever way you want. There's no hard science. And if you find that you can adjust your line slightly, especially if you observe some uniform activity, then your line could be drawn without connecting the absolute highs. Anyway, what I'm trying to say here is there was a break there. That break was corresponding with that break. So just keep that line on your charts. Let's extend it. You can see we came close to this with that high there. It came close to that line, which actually happens to be this high here. So I misspoke. So let's draw that again. So you can see resistance there. So the break actually took place here. And the market tried to rally, came back here and got smacked down. So that's a sell point. And that sell point was very successful in preparing you for this drop. Extend the same line. And guess what? Down the road, the market comes and makes three highs at the line on the RSI, which corresponds with this high, and this high, and eventually the market drops. So this back test line was warning you of resistance, and over a period of a couple of weeks, eventually the market did move lower. Now you might say that's not a good sell signal. Yes, I agree. That's not a good sell signal because the market keeps going higher. But if you draw the wedge, so there's a wedge, so the market is in essence trading in this wedge between these two lines, and you can always sell during this break point there, and that should have been good enough for a day trade, a swing trade, for a market that was poised to go down. All right, let's move on to another time frame, another example. So again, let's take a look at the Nasdaq daily between 2012 2013, and there was a major breakout in price at the beginning of 2013. Absolute screaming breakout move with a nice gap there that has never been filled. Okay, so we can see that the RSI broke out and we are connecting the highs. Again, you want your highs or your lows to connect with 69.1 or 30.90. So here we see that that was the high, the most recent high, and there was a breakout there in price, or in the RSI, which corresponds with this breakout in price. And so we just keep that same line and extend it down. So that makes sense, right? We extend that same line, and that line, ever since this breakout here, has become support. Was support here, which is this slight low and a move higher, double bottom support there. In other words, it looks like this. It looks like this. and that's double bottom support or support with uniformity twice. Either way, that was support right there, which is this lows. You got another support for a day trade, which is there, support there, which is this lows, and again support here, which is this low. So keep your lines, and that's the method. The method here is whenever you're day trading, if you can use your hourly charts to give you such type of a support line, then you need to use that for confirmation of a potential bounce. Remember, there's no certainty in the market. You're just using it to see whether you can get a bounce in a stock. Let's take a look at the current daily chart for the NASDAQ, and let's go back about 2 years. I think there's some example I was going to show you. And so if we take a look at this 2-year daily chart for the NASDAQ, there was a very nice move recently in 2014 from here all the way to this highs before a pullback. And so you can see that that took place during this move right here. This is where the move began. Good. So we draw and extend our line. And you can see that ever since that breakout, every time we come to the line and show uniform activity, remember, if there is no uniform activity, don't take the trade. You only take the trade if there is uniform activity. So again here, uniform activity, which is this entry around the 50-day moving average. Now, at this particular point, what the market did, let me show you what the market did, which to me is uniform activity, is it came back here and did something like this. I consider this to be uniform activity because you can split this in half. So that to me is uniform activity, and so that was this entry level there for a nice move, especially for short-term trading. And you can see eventually here there's uniform activity with this U-type formation like that back above, which was this entry point. Now, just to so I can let you know that yes, this works. During this time period, we went long because of this uniformity observation. So it's not trivial that we are just using this for the sake of video explanation, but during real-time trading, we went long around here in the market because we had seen this entry here. And also, just to remind you, one of the reasons why we went long was that there was another line we had drawn on the weekly and on the daily. We had seen that the market had been bouncing off these levels. As you can see here, uniform activity previously, triple bottom support, uniform activity here, and we had seen uniform activity above the line, below the line, and back above it. And we also kissed 30.90. So there was a lot going on at the time around here when we went long in the market because of this observation. So this does make sense that this method works. So that was the main line, and once the market went above, below and above it, that was a buy signal. So that's one way. Now I want to zoom into this level here. You might say, how is it uniform activity over here in this bracket here? How is it uniform activity? I'll show you. So there's a line like that, and what the market did was it came here and did something like this, I think twice, and then something like that. So all this is uniform activity at the line, at the line, at the line, and then this nice U-type formation. And once it moves above that, yours is just to buy, ask questions later. Okay, also you can see the market was holding around the 200-day moving average. So there's lots of indication that this could have been a nice entry level, and it was. I want to show you something else, and it is just a line here connecting the previous lows. So the RSI lows, remember we want our lines either to touch 69.1 whenever we are drawing them, or 30.90. That way we know that they are connecting to some important lows on the chart. So from here, I'm just going to draw a line connecting this low, connecting that low through here, and extend it. Okay, that's just a line I drew because I've had this line and I've kept it on my charts for a while. I want to show you why I'm drawing it. So we're trading here November 19th 2014. Somewhere around here, I think the market is giving us a sell signal. short term right now, right here, and I'll explain to you why. Well, because I have kept these lines on my chart for a while, and I can see that the market at this level here, what the market has done is it's come back to that area and rolled over. So that's what's going on in my opinion. And I'll draw the line again, this line. Now you'll say, why did I draw that line there? Because I can see here there's some type of uniform activity above the line back below it. Remember, if there's no uniform activity, we don't take the trade. If there is uniform activity, then we consider the trade. At this level here, I can say this was an odd shaped uniform activity above the line and back below it, so it looks something like this. It looks something like, and I would surmise to say that the average of this time period, all this is averaging out and looks to me like it is uniform. Remember, it can't necessarily be 1000% uniform, but I'll take it. The reason why I'll take it is because after this action here, which is this period, we had a serious 10% correction. So if the same line once broken, so we can take this movement back below the line, which is somewhere there, as a sell point, which would have been, we know it would have been correct way to view the market. How is it that the market has come back to the same line? So the market has come back to the same line, which is currently right now, and instead of moving above the line, found resistance and is now rolling over. I would take that as a sell signal and a short for the current market. Remember, it's just a line, and this line makes sense if you go backwards because it was support here on the way up. So the line had been established by the market. You didn't draw the line, I didn't draw the line. The market itself established this line. And if you spend a couple of, spend some time looking at this chart, you'll see that there was uniform activity below the line and back above it, which was this nice entry level there. And at some point we came and found resistance at the line there, short term, which is this small resistance there, which was this high. So the line, and once we found resistance, the market went down. We went above the line with no uniformity, back below it. So that was a buy signal. The market went up. So what I'm saying is you can use this line by itself to give you a lot of information on this NASDAQ market. Okay. And so the same line which was support in 2013, when you extend it in 2014, can help you identify turn points. Remember, if there is uniform activity, if there is symmetry, you can take the trade. If there is no symmetry and if there is no uniformity, don't take the trade. And that's how you use that uniformity understanding. So let's move on to another example. So let's go back again to the NASDAQ daily, and we are just going to find some uniformity turnaround situations. Number one, remember this was the period during the crash of 2008. So this was a very confusing time in the market, absolutely confusing. So let's go back and take a look at, there was a break in the market, this move here, and that led to the RSI breaking that trend right there. If we draw a straight line through the break, we can see that at some point the market came back and kissed that level there and could not move above it. So it looks something like this, what the market did, which is this period here, which is what I'm discussing there. And you can see that that line, if you extend it from the break, so remember the break there was this move off the highs, short term. So if you're looking for a trading situation, once the market comes here and shows uniform activity back to the line and resistance, then you can use that as a reason to go short, which was very successful, and on hindsight could have kept you in the market during the crash of 2008. I know that's easy for me to say on hindsight, but some of us were already expecting. Check out my video in September of 2008, 2 weeks before the market crash, and because of some of things like that. If you take a look at now when the market came off the lows, if you take the highs of 2007 through the highs of 2008, through the highs of early 2009. So you can see the line, that this line is well established, and this line has been drawn by the market, so it has no opinion in it. Once the market moved above that line and held, so once we had this movement above the line, it corresponds with this area here. Let's call it about March of 2009. If we extend the same line like that, you can see that that line gave us multiple entry levels off the low. You can see entry level during that support at the line, which is these lows here. And remember, this was a very tricky time in the market. Everybody was scared to go long. Support at the line here, which is these lows, perfect entry for a nice move. Double bottom support here, double bottom support, which is these lows there, perfect entry. Uniform activity below the line and back above it, which was these lows, and that couple days move higher. You have uniform activity back below the line and back above it, which is these lows here, which also happens to be around the 50-day moving average. You have these lows here and a move higher because the market kissed the same line and bounced. So we know for a fact that during this instant the market is being uniform. In fact, what I'm going to do is I'm going to go and come here and concentrate on this period here in 2009, so we can see that yes, it is uniform action, and what we are saying is uniform action, take the trade. No uniform action, no symmetry, don't take the trade. And so let me zoom in here to this 2009 period. So let's go to 09, change here, and let's go from January. Let's go to January of that year. All right. So here it is. So we've zoomed in, and so we can assume that the line was coming through like that. And you can see that uniform activity below the line, back above it. That's a fact. Nice entry. Uniform activity to the line. That's a day trade entry. Uniform activity kissing the line. Entry. Double bottom support there, which is this entry. Double uniform activity there, entry. You kiss the line there, 2-day move or so. Uniform activity below the line, back above it. That's a fact. Entry for short-term move. Uniform activity below the line, back above it, was this entry point here. You kiss the line there, this entry point. So how is it that the market kept giving us uniform activity on a line I just drew? Why? Because I think there's something to it. I think there's something either mathematical or there's something natural about these lines that we are drawing here. And the market seems to respond on those lines with uniform activity and then a move in the direction of the uniform activity. So let's go on to another example. So now we're taking a look at the current NASDAQ daily chart. So we've flipped from the 2009 daily chart now to the current 2014 November hourly chart. We're taking a look at 6 months hourly, and I'm just going to draw a line. There was a slight move. Remember, you can use this for day trading, short-term trading. There was a move here in the RSI that began this short-term move to new highs. At the time, these were 13-year, 14-year highs on the NASDAQ right there. Okay, so let me take that off, and we can see that that breakout connects us to the recent RSI high. So there was a breakout like that. Extend that line. And let's test this. If you're a micro trader trading small time frames, support at the line, which is somewhere here, for a move higher. You touch the line there with uniform activity, you get a couple of hours of a move higher there. Again, I guess it's now here. Uniform activity to the line, couple hours of up move. You got this triple bottom support, which is this level here, and a move higher for a couple of hours. Support here, which is this move here, and a move for a couple of hours, and then also eventually support at this line, which is this lows. So the same line, when once extended, can be used for timing intraday hour-to-hour trades. So you might say, I want to talk about something here. How do you know that? Because if you held here, eventually it went down. You held during this buy point, eventually it made fresh lows. If you bought here, yes, you had a move higher, but eventually you made fresh lows. How do you know that the market is not looking very good longer term? And I'll show you a simple trick. A simple trick is keep an eye on what happens at the 50 level. That tells you if the energy is bearish or if the energy is generally bullish. You can see here that the market kept and found it very difficult to move above 50. In fact, I want to show you something pretty awesome. Around the 50 level, so there was a break of the RSI there. We go back to our uniformity method. This uniformity method is absolutely powerful. There was a break of the RSI there and a break of the price somewhere here. If we take this break on the RSI and draw a straight line, which happens to be around the 50 level, you can see that the market has been coming back, or the market was coming back to this level, and every time with uniform activity, finding it difficult to move higher. Even here, uniform activity, even this during this area, which was the actual intraday high, uniform activity and resistance at that level, which was a high, uniform activity around 50, which was a high, uniform activity around 50, which was also a high, uniform activity around 50, which was also a high. In other words, 50 was a barrier. Strong stocks use 50 as support. Weak stocks use 50 as a barrier. And so we have buy signals coming from the break line and sell signals coming from the 50 level and the uniformity red shaded area. So there you have it. You have buy signals, sell signals. So if you're one of those who likes to trade small time frames, there is your method. Once the market moved above 50, take a look at what happened. So we know that our method is legit, because once the market moved above 50, finally, which is this period here, which corresponds with, let's say, somewhere here, the market has done well. That's a fact of life. In fact, as of right now, it seems to be wanting to hold 50, which would make this a short-term entry level about 2-3 hours ago. And the market has crept to the upside short-term. So we can see that above 50, the market should do okay. If it cracks 50, then that's a sell signal shorts are looking for. Now we go back to the Nasdaq's monthly chart between 1985 and 1996. So we go back, monthly chart between 1985 and 1996. Just want to show you that this method works across multiple time frames. If we take the highs in 86 through the highs of 87 through the highs of 89, something like that, and finally there was a breakout above that declining line. Oops, let me draw that a different way so we can actually connect most of the highs. And so let's draw it connecting this high, which touched 69.1 through this high and through this slight high. Just draw a straight line, and want to show you that there was a breakout in the market above those. So above these three highs, well established high line. Once the market moved above that there, which was this breakout here in middle of 1991, we extend that line on the monthly. Just keep it on the charts. It takes a second to keep it on your chart or to extend it, so there's no big deal in using it. And you can see we came and kissed that line there late 91 on a monthly chart, which happens to be this perfect entry, and the market went higher. We come here, we form a double bottom. That's uniform activity weaving itself above and below the line, and finally back above the line. That's uniform activity. Hope that makes sense. Which is this period here. It took a couple of months, but eventually the market found support on the line and the price moved higher. We come here, we show uniform activity below the line, back above the line, which was this nice lows there. We come here again, we don't touch the line, but we came very close to it and went straight. In fact, I can say that this period here on the monthly looks something like this, that the market did this, which is uniform activity, almost went parallel with the line here, is similar to there. So that uniform activity support, that's a buy signal in my book, which was this lows, and guess what? So there you have it. On the monthly, it also works when you go to the 80s. So guys, remember, the moral of the story here is keep your lines on your chart, or if you don't have the lines, draw your lines and extend them, see whether they make sense. So we are using the NASDAQ monthly again. In the prior example, we had drawn a line on the monthly connecting this high, and then this gave us uniformity, and then again uniformity here. So that line made sense. If we extend the same line without any adjustment, guess what? It gives us a nice low here, which is this drop and a bounce. So how can the same line down the road give us a nice support if this method is not legit? Of course the method is legit. That's why it makes sense. If we extend the same line, so we extend the same line, and I don't want to go into too much detail, but all this action is uniform. Uniform action there, uniform action there, uniform action there, seems like uniform action there, and finally you stayed above the line, which was this entry point there. Now this can, I'm sure people can argue about how legitimate that is, but that was an entry point there in late 2002, early 2003, and the market went on to make highs by 2007. So it's uniform in my book. I know it doesn't make any sense, but let me just spend a second, because you might say, how does that make sense? So we're talking about this period here. What I'm saying is, to me, I could have used that. I know it's an extension, it's not perfect, but this period here, what the RSI in my book is doing something like this. So bear with me here as I try. Came here, went up, down, back to the line, went straight down, back to the line with uniform activity, went up above it. See, it did something like that, touched it, was just playing around with the line. V-type formation, finally up, down to the line, and then took off. So this point here was this point there, which happened to be the perfect time to get in with a momentum move off the lows, and the market has not been back to those levels since then. So whether you want to call this all this uniform activity, I think they are uniform activity in my book. Uniform activity there, uniform activity there, and uniform activity there. I know it's weird, but it works. Let's take a look at the current NASDAQ chart, but actually let's take a look at the Dow instead of the NASDAQ. NASDAQ weekly, or the Dow weekly, 3 years. And what we're going to do here is adjust this slightly to 4 years on the Dow weekly currently, and just draw a straight line from this breakout that began in sometime beginning of 2013. Extend that line, and let's pick up pace here. You can see that all these periods after the breakout, so after the nice breakout here and the market took off, market has been using this for short-term bounce for swing trades every time, with successful moves, uniform activity to the line, and successful moves high in the market. Even there, here, all of these have been positive moves in the market, and recently we weaved below the line, back above it, and this is where we are trading. So yes, the uniformity line does make sense, and that's why over the last 2 years, something close to 2 years, the market has been coming back to this line, and those of us who've been watching this have been able to tell when the market was due for a bounce after a slight pullback. So quickly, this is the Dow Jones current hourly chart, we had moved above this line here, breakout above the previous RSI highs, which was this entry here. And since then, the market has been using this for short-term bounces. Without going into much detail, we had seen this on a prior NASDAQ hourly chart, but the market has been bouncing for a day trade opportunity on the same line once we extend that line. Keep in mind that once the market showed resistance around the 50 during this period, the market would go on to make lower lows. So during this period happens to be these lows here that the market found resistance at the 50 level on the hourly, and that's why the market made lower lows. Hope that makes sense. So resistance at the 50 with uniform activity at 50, which is this period, suggests that the market is on a downdraft. When the market is moving higher, it tends to find support at 50 with uniform activity at 50 also. Remember, we talked about that in part 1 of this video about when the market moves to the 50 level. So if this is the 50 level on the market, every time it comes and finds uniform activity on the weekly, daily, hourly, doesn't matter. But if you find the 50 level showing uniform activity, any type of uniform activity, even something as weird as this, then that tends to suggest that the market is bullish because it's holding the 50. If you flipped the script and you find that your market that you're trading is finding it difficult to move above 50 on any time frame, weeklies, hourlies, dailies, monthlies, any type of resistance at the 50 tends to be telling you that the market is gonna go back to fresh lows. So watch what happens with uniform activity around the 50 level, because it gives you a lot of information as to where the market is looking to go in the short-term direction. Let's take a look at another example, which is the Dow Transports 4-year weekly chart. 4 years weekly on the Dow Transports, and this one has been very good in telling us when to get back in the market on the long side ever since we had this breakout beginning of 2013. So nice entry there. This breakout, we just need to extend, and we have been extending this line. I have been doing this over the last 2 years. Every time the market has come back and found support here, we knew it was time to get back in the market long side. Support back to the same line, uniform activity, which is this entry level, and recently perfect uniform activity back to the line. That's why we went long back in the market during this period. So that uniformity line has been working wonders in terms of support on a very simple, well-defined line that we are studying here on how to trade the markets using an extension of a previously critical line. Now, why is it critical? Because we know that this breakout is critical for the market, because it is after this breakout on the RSI that we had the market start having this momentum move. So the market had been staying stable here for almost 1 year, going nowhere, and it's only after it broke out above that RSI level that we know that the market started moving higher. So that line, for some reason, has been the trigger, and the same line down the road is being used by the market for support. Now, how this works, I don't know. I just know it works, is my point. Let's take a look at one more, which is the Dow Transports, and you can see here, just gonna draw a simple line. So there was a breakout on the daily here. You just draw a simple line. The fact that the market did come back and kiss this line with uniform activity gave you day trade opportunities here. That's one line. There's another one that I saw and I see, which is a little bit more complex, but still makes sense. So what I'm trying to do here is figure out where the transport started moving, and I can see that ever since it moved above that range, which is this breakout, the market had a nice multi-week rally, okay, before a pullback. So we know that this was a nice entry level there. We also know that the market did come back to that range and hold support. So for some reason, this movement has been critical to the market, because down the road it comes back and finds support right here. So I can use that information by realizing that this slight move here in the RSI and a breakout was critical. So we draw a straight line like that. Now you'll notice that my line goes through this high and through this high. Remember, I told you you can adjust your lines. On both occasions, this is uniform activity, so I can draw my lines through the highs. Remember, we talked about this early in the video. If you find that your lines can be drawn and you can adjust your line, in this particular example, we've drawn the line through those highs. Through the highs, why not on top of the highs? Well, through the highs, because we have uniform activity above the line, back below it, uniform activity above the line, back below it. My theory is that the reason why that is, you can do that, my theory is that in essence, the market wanted to do this or something like that, but it could not do it. So what it chooses to do is do this and that, which if you take the average price there, probably is just flat. Because of that uniformity, probably should just be flat because of uniformity. So when I draw the line there, is because I see uniform activity above the line and back below it, so I can draw through it. Because what I'm aiming for is this perfect entry node. If you got in at that entry level there, would have been this move there. So that's a perfect entry. I want to take the same line and extend it. Now the line is going to make a lot of sense. A, because I've already studied the line, so I know. Sorry, but it's true. Uniform activity below the line, back above it. Okay? It looks something like this. And I was going to make this one video, but I'm going to have to split this in 2 videos because I have so many more examples to go. So it looks like that. So that's uniform activity, which is this entry point. If you're looking for a day trade opportunity, swing trade, there's your entry. Another support back at the line there, kiss the line, that's your entry on a day-to-day basis. Now, I'll tell you something. This doesn't look like uniform activity to you, but it does to me. So let me draw that again. Just because I've done this a long time. To me, this is uniform activity right there. Visually, it looks uniform in my book. And just take it for what it is, because we know that to be uniform activity, because even the market shows us that by doing that, once it moved back above the line, confirming uniform activity, it was this entry point here. You had a nice multi-day, multi-week rally. Now you come here during all this period and it looks very funky, but eventually you have uniform activity below the line and back above it, which is this entry level. And man, if you use that information like we did, you knew it was time to get long. It's a very simple extension of that line, and once the market gave you that uniform activity back above the line, you knew it was uniformity. Now I want to go and spend some couple seconds during this time period because I need you to understand why I consider that uniformity. So let me take this because I'm going to stop the video here and record this in 2 parts because the video is a little bit lengthy and I can talk about this market, so I guess forever. It's just a passion. So I want to take a moment and take a look at this period. I know it looks very complicated, very funky, but it's uniform activity, because what the market did in that period is, if I can duplicate all this, is we had a move up, down, up, sharp move, and then lower. We came back, we kissed that line, and we came down and moved back above that. So that's what it looks like to me. In fact, if I draw the line just slightly compensating for, if I draw it right there, this is exactly what's going on. So you can see that you get multiple uniform activity, uniform activity, uniform activity, and then uniform activity. So the totality of that is uniform activity. I think what the market was trying to do, but it can't, what the market was trying to do in that period was actually do this, was come here, go flat for a couple days, couple weeks, and then move higher. And this move higher was your buy signal, which is this level here. which would have been somewhere here, but the market can't do this. Instead, it does this, which is uniform activity, is my point. Okay, so all this in theory is uniform activity, should be this. In your mind, you should see a straight line. And so once the market jumps above that, time to go long. Okay, let me show you another way to view this as I conclude the video here. I'm going to draw a simple line. Now this line has been on my charts. I'm not kidding, but I'm just, trust me on this. Maybe I should explain why, but anyway, this line has been support on this chart, and we've known this for a long time. And guess what? Uniform activity to the line, which was this low, and then again V-type formation back above the line. That was a buy signal. In fact, even before the market, if I can find the video, I would show you when the market was looking like, so I'm gonna go and zoom in here. At the time when the market had done this, I told subscribe, the market had gone down during these down days here. The market had closed down like this. I told subscribers, be very careful, because the market could easily form a V-type formation, giving us uniformity and a buy signal. And to my surprise, if you can call it surprise, this was exactly what happened. 2-3 days later, the market formed uniformity back above the line. So what we were expecting as uniformity became uniformity, and that's why we knew it was a buy signal. Once you see it, it's amazing. I'm gonna stop the video there. I know it's too long, but if you find uniformity, if you find symmetry, take the trade. If you have a good line showing you a breakout or a breakdown in price, and if you extend the line and down the road, if you see the RSI coming there with uniformity, with symmetry, take the trade. The market is saying something. Eric Muade, good luck, peace, and blessings. Mwah! I am out. Woo!